Have high expectations for your finances but lack extensive knowledge yet? Not a sweat. These 20s money advice will assist you achieve your objectives. Your 20s may be a very transformative decade. That's the time when you might move out on your own, begin working, and truly begin to discover who you are. Making wise financial choices in your 20s can help pave the way for greater opportunities for you in the future. Number 9. Start with an emergency account to bolster your confidence. The cornerstone of your financial life is an emergency fund. It's no accident that it's called a financial confidence account. Having rain gear on hand might make you feel at ease on the inside. Additionally, when faced with a financial difficulty, you may make wiser options if you have constructed your safety net. Create an account that is easily accessible, kept apart from your primary checking account, and used exclusively for emergencies in order to start your emergency fund. Storing your emergency funds in a high-yield savings account or truest one money market account is a wonderful idea. Next, use your online banking to set up automatic monthly transfers so that you may save first and automatically. If you don't currently have any emergency funds, try saving $1,000 first. Next, make sure you have 3 to 6 months worth of living expenses saved so you can be prepared for unforeseen circumstances like losing your job. As your emergency fund continues to increase, enjoy the peace of mind it can provide. Number 8. Make sure your expenditure reflects your priorities. Aligning your spending with your principles is the greatest approach to make sure you're getting the most out of your financial situation. To find out where your money is going, you might start by just keeping track of your expenditures. After that, you can create a budget by deciding how you want to allocate your money going forward. Open in a new tab after downloading our budget spreadsheet. Your budget should include line items for necessities such as debt repayment, groceries, utilities, and rent. After you've taken care of the necessities, list the things that are most important to you. The remainder of your revenue can be allocated in accordance with those figures. That can include giving spending on experiences and travel top priority for certain people. For others, it can entail making as many extra loan payments as they can in order to pay off all of their debt. You may be in the middle, but putting your values in writing, giving them a rating, and creating a budget that reflects them will help you reach your objectives and feel good about the things you're saving and spending money on. Number 7. Give debt repayment top priority. Most of us in our 20s have debt, whether it comes from credit cards, vehicle loans, college loans, or all of the above. You might want to focus on paying off any credit card debt you have first. Due to the high interest rates associated with credit card debt, you will ultimately pay a lot more for items than you would if you could pay for them with cash. According to Brian Ford, head of financial health at Truist, you have to pay more than the minimum to get out of debt quicker, and clearing out high interest balances under $1,000 is a great place to start. Cash flow is freed up by prioritizing something and using every dollar at your disposal to crush it. Put all of your additional cash towards the next loan with the highest interest rate. If you follow that strategy again and again, you can find yourself debt-free far sooner than you've anticipated. Number 6. Raise your credit score steadily. Monitor your credit score as you persist in addressing your debt load. Over time, managing your debt will help raise your credit score. When you're ready to take on more ambitious financial goals like purchasing a home, a score above 720 can make borrowing cheaper and easier. You most likely don't have a long credit history if you have never taken on debt. Applying for a credit card is one way to use credit, which is necessary to establish a credit history. You won't pay interest as long as you pay off your balance in full each month, which will also demonstrate to lenders your dependability as a borrower. Even while it's crucial to establish your credit history, you don't have to apply for every new credit card that comes your way. The cause? The average age of your accounts determines a part of your credit score. Generally speaking, new credit applications are also considered hard inquiries, each of which temporarily lowers your credit score by a few points. Lenders may interpret the filing of several credit applications in a short period of time as a sign of impending financial instability. Number 5. Invest to position yourself for financial success in the future. IRA, Roth IRA, and 401k are just a few of the retirement terms that you may be familiar with. The good news is that starting a retirement fund and making regular contributions are more important than choosing the sort of fund and how much to invest in your 20s. At first, it may seem like a lot to figure out. Starting to save in your 20s gives you a better chance of generating wealth and achieving a happy retirement, since the amount you save and the interest you receive have more time to compound. More money is what your future self truly needs and wants, according to Ford. A change in viewpoint is the best method to guarantee that. When you begin or increase your 401k contributions, you're doing more than just saving for the future. You're laying a solid foundation for the person you want to be in the future. This change in perspective may make you feel better about putting money down for investments when you're young. A simplified method of positioning oneself for the future: establish automatic contributions to an IRA or 401k from each paycheck. Additionally, a lot of firms will match your 401k payments. When you confidently work towards other financial goals, you can watch your investments grow into a great nest egg over time. Pro tip: refer to the chart to see how starting your retirement savings in your 20s might significantly impact your situation over time. Number 4. Protect your data and online brand. Like the majority of people in their 20s, you most likely have an internet presence. It's simple to disclose more about ourselves than we may have intended to with the abundance of social media sites and web pages available. You may help protect your personal information by taking preventative measures such as using different passwords, enabling two-factor authentication, and keeping an eye out for any strange activity on your credit report and financial accounts. Since your career is only getting started, you should also think about how your internet presence can be perceived by potential employers. Examine your past posts on social media and accounts to be sure nothing might be used against you by your present or future job. To help create and safeguard your personal brand, think about how you want to be perceived by people online. Number 3. Verify that you have coverage for various situations. In your 20s, insurance may not seem like the most fascinating financial issue, but it can help prevent bad situations from growing worse. Additionally, you'll probably have to deal with enrolling in your first plans and quitting your parents' insurance. Getting the basic insurances, such as health, house, and renter's insurance, should be your top priority in your 20s in terms of education and protection. You may discover the nuances of insurance as you determine which kinds of plans and how much coverage you actually need to feel secure by starting with these fundamentals. Number 2. Take into account preparing for homeownership, but don't hurry into it. Your desired way of living should guide some of your decisions, such as whether to buy or rent a property. Purchasing a home can be a great method to begin accumulating wealth if you have the money for a down payment and want to live in the same location for at least 5 years. However, if you value flexibility, aren't ready financially for homeownership, or just don't want the extra responsibility, renting can be a better choice for you. There's a requirement of homeownership to have sufficient funds for paying the mortgage, utilities, insurance, property taxes, homeowners association, HOA, dues, maintenance, and repairs. In addition, a sizable down payment is usually needed in addition to other upfront expenses when purchasing a home. All of that might seem like a lot now, but you can become a homeowner in the future if you begin saving for it in your 20s. However, your 20s are also a time for self-discovery regarding your ideal lifestyle, including where and how you want to live. If renting fits your lifestyle better, you can still accumulate wealth. Number 1. Invest in yourself instead of just your money. Recall that your biggest asset is you. To position yourself for long-term success, Ford advises investing in networking, information, education, and skills in your 20s. Invest in yourself with your money, advises Ford. Getting you on the proper course early in your career will yield larger dividends. According to Dixon, part of your job now is to put everything you've learned into practice. By doing that, we strengthen our sense of self-efficacy, the conviction that we possess the ability to overcome obstacles in the future. Furthermore, you will feel more equipped to handle obstacles in the future the more difficulties you encounter now, whether they are financial or not. If you found this video informative, make sure to give it a thumbs up and share it with your friends. We love to hear your thoughts, so drop a comment below and let us know what you think.